Welcome to The Gray Report. I'm your host, Spencer Gray, and every week on The Gray Report, we are breaking down the latest research reports, articles, original opinions about the multifamily industry, real estate, whether that's residential or commercial real estate, the macro economy to help listeners like you make some really well-informed decisions, or if you're working in the multifamily industry, giving you insights on what you do every single day. Folks who listen to the Gray Report are investors, they're industry professionals, they're brokers, they're lenders, insurance agents, and just folks that are curious about real estate investing and the multifamily market. Typically, not people who are brand new to real estate investing, but folks who want to take a deeper dive and increase their knowledge base of what's going on in the market. Today's going to be a little bit of a different episode. As you see, I'm not joined by a co-host or a guest on the show. Typically, I have a co-host or a guest. Today, it's going to just be me. My name is Spencer Gray. I'm the host of The Gray Report. I'm also the president and CEO of Gray Capital, a multifamily investment firm located in Indianapolis, Indiana. We're really a real estate private equity shop that does our own property management, construction management. We go and we identify market rate multifamily assets to acquire that are typically stabilized and cash flowing. Find those opportunities. We raise capital from individual accredited investors, family offices, registered investment advisors, institutions, and other types of entities in order to collectively syndicate that capital and close on that project. We're typically holding these projects for at least 5 years, often longer, occasionally shorter, to try to multiply investors' capital and produce cash flow along the way. That's a little bit about us. If you are watching today, it's probably not your first episode of The Gray Report. And if you have been watching the last few episodes, you've probably noticed a little bit of a change. And that is that I am not joined by my co-host, the producer, Matt Bosnagel. Matt is no longer a member of Gray Capital and is no longer a co-host of The Gray Report. Now, Matt has just done an incredible job over the years building this podcast and our newsletter to what it is today. And so, Matt, thank you very much for all of your efforts. It's an incredible run, and we're wishing you the best of luck in your future endeavors. I wanted to just provide that update if you are a longtime watcher and you've been curious, hey, where is Matt and who are all of these new individuals that are coming on the Gray Report? It's been a great opportunity for me to bring more members of the Gray Capital team, some of which have sat in on previous episodes of the Gray Report, either filling in for myself or Matt. Some of those are new faces as well. It's been a great opportunity to share their voices with you because they're really smart people that have some additional unique insights beyond what I can just share with you, whether it's from Katrina Green, our Senior Vice President of Property Management at Gray Residential, who has almost 30 years of experience working in the multifamily industry, the property management, from being leasing to being a property manager, all the way up to being on the vendor side. So an incredible amount of experience. To Jay Reeder, who's our Chief Investment Officer and has been involved in asset management, acquisitions, development of student properties, affordable properties, market rate properties, and is really the brains behind our acquisition potential here at Gray Capital. He is the one that is in charge of underwriting the deals with our entire acquisitions team, taking those deals from, again, underwrite through due diligence to close, and then continuing to manage those assets from an asset level after we have acquired them. Also, Blake Peroni was on the show, and he is our head of investor relations. An incredible story. This young man, which is just going to call him that, incredible career. Multi-gold medal Olympic swimmer, gold medals, silver medals, incredible drive, joined the Gray Capital team about 3 years ago. And if you are an investor of Gray Capital, I'm sure you've had the pleasure of speaking with Blake many times, but very sharp, very intelligent, great at what he does, understands the entire investment process, very eager to learn, and has learned. It's like he's been in the industry for decades, the amount of knowledge he has been able to soak up and execute on. And so it's great to talk to him about what he's been doing in terms of capital raising for our projects, future projects, and a little bit about his background. So we've been in a little bit of state of experimentation on the Gray Report, trying some new concepts, new guests, new co-hosts, and that's what we're doing today. It's just a solo episode with myself. I'm going to get into some of the articles and reports that are out this week, and I'm also then going to get into a little bit of detail of the history of Gray Capital, kind of going back, unwinding a little bit, because while it's part of our company history and our culture, it's something I talk to the team about a lot. And if you're an investor, I probably have told you my story and the story of Gray Capital. But there's only so much that I can put in a bio, and so much that we can just drop on our website. There's a lot more details there. So I'm not going to be able to touch on everything today, but I am going to give you a little bit of an insight of the history of this company, Gray Capital. All right. Well, that was a long intro. Let's get into it. All right, welcome back to the Gray Report. Again, I'm your host, Spencer Gray. Let's get into some of these articles related to the multifamily industry. This is a little bit more macro, but it's right on the headlines. Have to talk about it. And I thought that we weren't talking about interest rates anymore. I said we are done with that. Not forever, but at least last week we had the big FOMC meeting. Obviously, Fed funds rates were decreased by 25 basis points. Talk of further rate cuts throughout the year. And as we see here, as I pull up SOFR, 30-day average of SOFR, it has dropped from, again, when we were back in September 2024, it was all the way up at 535. We had several rate cuts. And SOFR is, pretty directly tied to Fed funds rate. We slid down eventually getting to, by January of this year, basically it was 432. And then we're getting ready to come down another 25 basis points. Looks like it hasn't filtered in through this chart. That's certainly a relief to some borrowers' floating rate debt. But more than that, I think there was hope that it would be an inflection point, that things would start moving in terms of interest rates into a more accommodative light, in that the Federal Reserve was going to be much more accommodative rather than restrictive. Because the fact is, the concern, and we're looking at a map of employment or unemployment in the United States. The chief concern here is a slowing labor market is outweighing the concerns of rising inflation. And if you're a listener of the Gray Report, or you're digging into this stuff all the time, you know that if you take shelter, real estate, specifically shelter, out of CPI, which is the main kind of inflation gauge that we use. If you take shelter out, inflation is basically at 2%, which is the Fed's target. And the way that shelter, especially the owner's equivalent of rent, is calculated in CPI, it doesn't really make sense. It's a lagging indicator, especially when we look at private data sources. We know that rents have been flat and negative across the nation on average. However, in CPI, it has never shown to be negative. So we've seen, not only positive CPI growth, but specifically for shelter, which makes up 30% of the overall weighting on CPI. So if you're nuanced enough and you can see through the headlines, you could start to come to the conclusion that, well, maybe inflation isn't as concerning as we were all thinking. Obviously, there's tariffs that are, hanging out there. But the conclusion from the Federal Reserve and the FOMC seems to be that, look, when that price spike from tariffs does filter into the data, let's look at it for what it is, which is most likely going to be a one-time price hike. Unfortunately, the amount of uncertainty that tariffs have have embedded themselves throughout not just the economy, but society, is leading to a inability from business leaders and individuals to make big decisions. And again, it fascinates me that the idea of tariffs or monetary policy, interest rates, inflation, which impacts everybody, but can be relatively heady topics. You're not always hearing everyone always talk about, I am, but that's kind of what I do every day. not everyone at the hair salon or the barber shop or the coffee shop are talking about inflation every single day or monetary policy or the Federal Reserve. And maybe I'm wrong, and maybe everyone is, but I'm assuming that the conversations I'm overhearing, that's not what everyone's talking about. Nevertheless, everyone or most people are unsure about where the economy is going to be. I'm asked all the time, every day, where do you think interest rates, Spencer, where will interest rates be next year? Where do you think the market's going? I'm by default an optimist. So I'm going to paint a relatively positive picture. And it's not because I'm talking my own book. It's mostly through observation over time that we hyper focus on the worst case scenarios, when often the desire in the psychology in the invisible hand of the economy often tries to find solutions. And it's not always as bad as it seems. Not that there can't be black swans, not that things can't get really bad, and not that you don't observe trends to see where you might run into danger. But generally, people are always calling for World War III. It's a civil war. We're going to see hyperinflation. And I'm somebody that's like who believes that we have problems that we need to fix in society, but it doesn't mean society is going to crumble tomorrow. So generally, I am an optimist, but I can't predict the future, and no one can predict the future. So business owners, when it comes to hiring for growth, you have to understand what growth may look like. And if you're in an environment where you don't know what your cost of goods because of tariffs, you don't know if we're going to find ourselves in a recession over the next couple of months, you may not make that hire. You might not make that purchase. You might not make those plans or start to execute those plans because you want to wait and see. Not only are business owners coming to that conclusion, but individuals are. And we're seeing it in the apartment industry. We're seeing very slow lease traffic, not regardless of the addition of new supply. I think all the new supply is making a more competitive market. There's a lot of slack in the system. But that doesn't explain everything, because it's not as though all of the new traffic, new individuals who are looking to rent a new apartment, it's not like that's staying constant and our renewals are at the same rate. So when we look at renewals, people are staying at our apartments longer than they have in the past. And this is a very new phenomenon. Instead of seeing renewal or retention rates, which is how often somebody stays at a property, on average of 50%, which is the industry average, and it shockingly often is the case that your retention renewals are right at 50%, plus or minus maybe 5%. But now it's very common this year. Really started seeing at the beginning of the year, renewal rates in the 60%, 70%, 75%. And it's regardless of market and the new supply that was coming on in that market. And to me, that's direct evidence that it's uncertainty that is driving that lack of decision-making ability. And then that lack of decision-making ability, coming back to business owners, is leading to a lack of hiring. So the concern has shifted from inflation, which again, just talking about CPI, may not actually be the concern, and it's on to the labor market. And the labor market and the economy desperately needs some certainty. Jerome Powell gave a speech today. He was in Rhode Island. I had a couple quotes, but that gives us a bit of insight of his stance, where himself and the rest of the Federal Open Market Committee are. It says, this policy stance, this is a quote, this policy stance, which I see as still modestly restrictive, leaves us well positioned to respond to potential economic developments. The policy statement, obviously referring to reducing the Fed funds rate by 25 basis points. What I'm pulling out here is that even that reduction of 25 basis points, he's still seeing as moderately restrictive, which would indicate that we would see additional rate cuts. The market is pricing in 2 additional 25 basis point rate cuts throughout the year, although there is some talk that maybe those don't happen. Another quote, near-term risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation, he said. Two-sided risks mean that there is no risk-free path. That was actually my favorite quote. And Jerome Powell, he will drop some banger quotes, this is just so universal. Two-sided risks mean that there is no risk-free path. And I would argue in most cases in investing or in life that we're often facing two-sided risks, the two sides of the coin, double-edged sword. And it's true. There's no risk-free path. There's no risk-free path in life. It's just we have to acknowledge that and accept it. Going on, quote, the increased downside risks to employment have shifted the balance of risks to achieving our goals. This policy stance, which I see as modestly restrictive, leaves us well positioned to respond to potential economic developments. Continuing, uncertainty around the path of inflation remains high. We will carefully assess and manage the risk of higher and more persistent inflation. We will make sure that this one-time increase in price does not become an ongoing inflation problem. That would seem to say, hey, we know that we might see a little bump up of inflation because of tariffs, but we can handle it. It's not going to be that big of a deal. Everyone just calm down. Earlier Tuesday, which is the day we were recording this, September 23rd, Fed Governor Michelle Bowman warned about the dangers of moving too slowly to address the labor market. Bowman, a Trump appointee, said, and I quote, "We are at a serious risk of already being behind the curve in addressing deteriorating labor market conditions." She goes on to say, "I am concerned that the labor market could enter into a precarious phase, that there is a risk that a shock could tip it into a sudden and significant deterioration." All this at a time when the S&P 500, the stock market, essentially is at an all-time high, leading to concerns of a potential pullback and a relatively fragile situation of so many eggs in the basket of AI, but also the Mag 7, seven very large technology companies that have a concentration of capital and a change in the narrative of the story, whether that be related to AI and the promises of productivity, or just a huge wrinkle in earnings related to the Magnificent Seven companies. Really, even just any few of those could lead an entire market downturn in some sort of correction in the 10 to 20% range. In my opinion, may even be healthy. We're already exceeding the price targets for the S&P 500, according to many of the major investment banks. And so when we're looking at a situation of where unemployment is potentially weakening, it doesn't necessarily track that the stock market is at all-time highs, unless the market is indicating, as it is a forward-looking indicator, that we are going to work through some of these problems at some point. Until the narrative changes and the fundamentals change, that's going to be the underlying theme. So on one hand, fundamentals look shaky. Fundamentals specifically employment. The market's trying to look past it. I think the key is, from my perspective, this is where the optimism comes in, is that if uncertainty can be reduced, which is much easier said than done, we might be able to give that confidence to business owners to be able to continue hiring, continuing their plans for growth, and achieve this soft landing that has been in the works really since 2022. I think we could still do it. We haven't absolutely broken the economy yet. Things are out of balance, but we'll never get to a perfect balance because we're not a perfectly efficient market. On to multifamily. According to Axios, America's apartment boom is ending. It's ending. Now, they're not talking about multifamily investing. They're not talking about people living in apartments. What they're talking about specifically is multifamily construction. We've talked about this a lot on the Gray Report of how supply levels are receding, permits are receding, but are they receding enough to move the needle and to give owners and operators a little bit of breathing room? Because the reality is there's a lot more competition on the market than there used to be. More than 500,000 new apartments are expected to be completed this year in 2025, down roughly 21% from last year's record. However, That's still above the annual average this decade. So while the reduction is relatively significant, there's still a lot of apartments coming online. And we still actually need a lot of apartments to be built. Depending on who you ask, we still have a deficit between 4 and 7 million housing units in the United States. And any slowdown in that construction activity will further the issue of housing unaffordability. With interest rates as high as they are, we all know that it's hard for individuals to go buy a single family home. They're having to rent because buying isn't an option. And rents, while they've been kind of flat for the last few years, they're much higher than they were 5 or 6 years ago. The perception that rents are high. And again, even if they haven't grown a lot over the last few years, many individuals in many markets are exceeding that kind of 30% threshold of rent to income that is considered rent burden, according to most people. And again, the consensus is, the rent seems really expensive and we need rents to come down. We've learned the pandemic confirmed something that we've always known, and it's as simple as supply and demand, is that when we build more apartments, so if we add more supply, prices will come down. And not just prices of luxury apartments, which are often the type of apartment that's being delivered, but prices of B-class apartments, C-class apartments will come down if there is a significant amount of new supply of any type of apartment. So building is the answer. Unfortunately, debt equity has been harder to come by. The capital to build new apartments just isn't there. And again, this uncertainty is not exactly leading to more and more deliveries. So we need to continue to build more, but we're not building enough. We're still building some, but we're not building enough. According to the Harvard's Joint Center for Housing Studies, wrote in a June report, the multifamily construction boom is ending. So while that is potentially good news for apartment owners, it's not necessarily good for apartment renters. A lot of talk of a potential national emergency related to housing from the White House. Scott Bessent, Treasury Secretary, has talked about this multiple times. It'll be interesting to see what solutions they end up proposing. Deregulation has been kind of the tune that everyone has been singing, but how will that be achieved? Can we get to some sort of kind of more universal, zoning standards? Can states step in to say we're going to have one set of standards for each county? Not if you go across one county line, you have a completely new sets of zoning and restrictions. Can we make it a more straightforward process? I think that would certainly help. Certainly being less restrictive. The markets like New York, there's all kinds of restrictions on building new housing and also how to deal with tenants once they're there. If you can't evict someone who has been squatting at your apartment for 6 months, it's hard to make further investments into that market. And so by easing up on some of these restrictions may lead to more housing. The other piece, another carrot rather than the stick, is this idea of middle income housing tax credits. We're already doing it for low income housing tax credits. And if the solution is just we need more housing, you could just issue more tax credits. That you could argue that, maybe there's some lost tax revenue. There's always, again, there's two-sided risks. There's always risks regardless of the path. But if you really wanted to lower rents, you wanted to build more housing, you just increase the amount of tax credits. Low-income housing tax credits, create this middle-income housing tax credits. Again, I am not a big fan of government involving themselves in industries in putting the weight on the scale. But if I was dictator of the United States and we wanted to solve the housing crisis, you'd issue you would triple or quadruple the amount of LIHTC credits, and you would create the MITEC, middle income housing tax credit, and you would add another 500,000 to 1 million housing units. You could do it in 3 years. Now, this would be not good news to developers. It would be not good news to owners. Rent would be flat. They might be negative. That's what Austin has been experiencing because they did deregulate. It would be good for builders because they would be earning some sweet development fees. Again, the current system is not just we're giving affordable housing, it's welfare for the wealthy. Developers are making nice development fee checks when they build these buildings. And they need to be. They need to be incentivized. Otherwise, why would you build it? They're not doing it for charity, and they never will. But let's not kid ourselves that it has to come out of both ends. The folks that really need it and the folks that we need to do it. So developers, it'd be a big boon for developers. We'd be able to build enough housing that we would need. And some of it would be, light tech, income restricted. Some would just be market rate. Maybe it would still be somewhat income restricted. But, I think, middle income, they've talked about anything anywhere between like 80 and like 120% of area median income. If you know more about the middle income housing tax credit, comment down below. But I think the solutions are out there. We just have to have the will to pursue them. Further on housing, U.S. single-family housing starts near 2.5-year low as inventory bloat weighs. We're starting to see, again, not like any major price declines in the single-family housing market, although we are seeing some declines in some markets. But generally, as a nation, it's relatively stagnant, relatively flat with, again, some declines in some key markets. But the fact that we're seeing a 2.5-year low in inventory or housing starts is a good sign for that, again, for at least the home builders trying to move product, but it's not surprising. Costs of owning a single family home are up significantly compared to the last few years. Multiples higher if you talk about the costs for mortgage, insurance. More people are forced to rent. I think it's fascinating that the single-family home market has been as robust as it has been. The fact that it has been able to post gains in some years and is at least flat. The fact that you can increase interest rates to this degree and still have a functioning single-family housing market, I think goes to show the robust nature of the U.S. housing market and the U.S. economy. And again, putting my optimist hat on all of this, the fact that we can get through tariffs without a recession, again, depending on how you look at the numbers, we can get through tariffs. We can get through raising interest rates from March of 2022 to 24. We can increase interest rates over 500 basis points, and technically not cause a recession, which maybe we kind of did back in first quarter of 2023, but it never technically qualified. But the fact that we haven't been in a tailspin, I think, shows that the United States economy is robust fundamentally, is incredibly strong. It's not perfect. There's a lot of things that aren't good. But travel somewhere else outside the United States, talk to them about their economy. It makes you really appreciate what we have here in the United States. Again, not perfect. A lot of things to fix. A lot of things in society aren't great. But it could be a lot worse. And it's a privilege to live here. It'll be fascinating as interest rates come down to see more construction. And that is my base case. I think we're going to see a slowdown in deliveries as indicated by starts and permits. But there is enough capital out there that wants to continue to invest in housing because it is in demand. Even with higher interest rates, demand has been peaking. On the multifamily side, it's at a decade high. Even if rent growth is relatively stagnant, the economy is surprisingly resilient. And if we could rid ourselves of some of this uncertainty, we could be in a really good spot. Now, do we need to have a pullback before we get there? Perhaps. Again, I think a lot of the AI productivity is real, but it's also real hype. And I think it's the timing can vastly offset the outcomes. I think the productivity boom from AI could potentially save us from a potential sovereign debt spiral. We got way too much debt in this country, but productivity could significantly alleviate that and allow us to maybe even grow out of it. it's an incredible tool, but it might not happen this year, might not happen next year. And if there's any article, if there's any change in the narrative of the timeline or the effectiveness, or if the productivity enhancement isn't really there, we could see a correction very similar to the dot-com bubble. Yep, the internet's going to be a thing. It is a thing. But maybe we haven't figured out the timeline or all who the real players are just yet. But over the long term, again, I'm pretty optimistic. Let's talk about Great Capital. So I founded Great Capital back in 2015 with my wife, Alex. We had just sold a business. We had started a business called Sugar Creek Hops. Going back even further, before we started Sugar Creek Hops, I was working as an audio engineer. I had been producing music. I used to write music. I still write music, but most of the time producing it. A lot of work for Audible, doing a lot of work for Audible.com, editing audiobooks. You may ask, you may have noticed, we've got some fancy microphones, AKG 414. It's because I used to work in recording studios and had a lot of this equipment, or once I had a business, I could write some of it off as an expense. Why not? At the same time, I was starting to flip houses. I had always been flipping houses on the side, maybe like one deal a year, maybe a few. And it was the way I was supplementing my income because I was not getting enough always consistent work being a recording engineer, being a freelancer. From the beginning, I always wanted to work for myself, wanted to be an entrepreneur, wanted to be a business owner. I'd seen my parents found a business back in the 1980s, early 1980s, 1984. And I watched them build a business from literally nothing, from a rundown, not even a real horse farm. It was an abandoned horse farm, essentially, with a horse. The horse came with the farm. And my parents bought a shipping container full of tanning beds. So they thought that there was a market in the United States. My dad had done some research, and he sold that container of tanning beds and achieved a very large multiple on what he was able to sell. So there was clear demand. So he hired another sales guy. He hired an accountant. And they quickly grew that business eventually to the largest manufacturer of tanning beds in the world and the largest manufacturer and seller of indoor tanning lotions and also sunscreen. You may have heard of the brand Australian Gold. It's a sunscreen you can still buy. Saw them build that from absolutely nothing to selling it in 2005. An incredible story to watch. And I always knew that I was also always going to have my own business. Why would I want to work for anyone else if I could start my own? I incredibly blessed and fortunate, not for just for the situation in the network that my parents allowed me to be able to have, but teaching me a different path of entrepreneurship. When I talk to people all the time, who've read Rich Dad Poor Dad, and I read Rich Dad Poor Dad for the first time about 12 years ago. And if you haven't read Rich Dad Poor Dad, Robert Kiyosaki, I think you should read it. It's a very elementary book. It's like very simple. It's supposed to be super simple in elementary. Not everything's right. You can criticize Robert Kiyosaki for a lot of good reasons. He's a little off the wall, especially today. But the lessons in that book open a lot of people's mind of viewing society and the economy for what it is, not just what you were taught to believe or an idealized version of it. And a lot of it is trying to chart your own path and seeing how the economy works and deciding, do you want to be reliant on a wage that typically has linear growth? Or do you want to acquire assets over time? And specifically, build a business that acquires assets that can have an exponential growth rate. And just very simply, you want to be an entrepreneur in businesses that buy or create assets for you to continue to grow, giving optionality and freedom in the world to choose how to use your time, where to spend your time, who to help. And again, significantly more freedom than if you just have a job. And so I learned from my parents that this was not only an option, but it's doable. And so I always pointed myself in that direction. First, it was with music. I wanted to open a recording studio, driven by passion. I quickly learned that recording studios are going out of business left and right. Literally, I was interning in New York City in recording studios, and they were closing. And I was trying to build business plans and spreadsheets. I couldn't see how any of them were making money, and most of them weren't. They were passion projects. Some make money, but it's usually somebody had some money and they could keep it going. So that's when I was working in kind of other areas of media distribution, producing audiobooks and all of that. But that's not really why I had gone down that path. I was passionate about the creative side, and I wasn't really able to harness that in the job. And I said, well, what else is out there that I can build a business? I can still be creative. And then that's where I kind of gotten into flipping houses on the side. I always knew that I liked real estate. I didn't think it was going to be my full-time thing. I thought that I would always be doing something, and I'd be doing a real estate deal on the side. Always doing a real estate deal on the side. Kind of building up assets. But I thought I'd be going a different direction. And I was flipping a house. I was working for Audible.com. And then my then girlfriend, now wife, Alex, and a buddy of mine, who also worked here at Great Capital for a while also, we were drinking a beer, and we were like, all these craft breweries are popping up everywhere, and they're brewing all these IPAs. Where are they growing all their hops for the IPAs? And Indiana, where I'm from, we're one of the better top agricultural states. Why aren't we growing all the hops and in the ingredients? Why can't we do it all here? And this was kind of right in the middle of the kind of buy local movement. This is like kind of 2012, 2013. So I started calling up local breweries, and I said, if we grew our own hops, would you buy them from us? And they said, yes, we'd love to. We can't find hops anywhere right now. If you can get us any hops from anywhere, we will buy them from you. And I said, okay, I think there might be some demand here. Now, I didn't know anything about hops at the time. My family has a farm in northern Indiana. My grandfather, he grew up on a farm. Again, my parents run a horse farm. We have a lot of agriculture in my family. It's a corn and soybean row crop farm. And I was like, well, I've got a place to do it. Talk to the farmers we work with, see if they knew anything. They didn't know anything about it. It's okay. One thing I did learn is that it takes about 3 years to get a crop. I'm like, well, we're not going to have anything to sell to these guys for 3 years. That's a tough business plan. So I started calling up farmers, not in Indiana, but in Yakima, Washington, which I learned grew almost all of the country's hops. This one little area. I quickly learned that there was only like 70 commercial hop farmers in the United States. And they like all lived in Yakima, Washington, besides like 4, which lived in Willamette Valley, Oregon. And so it's a small world. And so I kind of figured out I found one of them, or a guy who was in the industry. He was kind of retiring. And we were kind of trying to buy supplies from him. And I said, hey, can we fly out to meet you? We want to learn about the industry. Sure. You fly out, of course. I'll make time. So we did that. Met with him. Met with these hop farmers. And learned that it's a very small industry. It's unregulated. It was fascinating. So niche. And they were in an interesting spot because they were transitioning from basically having a very small handful of customers, like AB InBev, Budweiser, Miller Coors, and that was it. They were selling to big macro breweries, the big domestics, and then these craft breweries were opening up, and the craft breweries were trying to buy hops, and the farmers wanted to sell to them, but there were these old brokers, the way the hop industry works are these brokers that typically sell to the brewers, and the two main hop brokers, Hopsteiner and Barth Haas, were these two old German companies that are like 500 years old. They're called German hop merchants, and weren't really too big on the craft beer scene. You think that they would be, and they are now. They eventually they caught up to speed, but at first they're like, who are these? Who are these Americans who are brewing these beers that are not the way we brew beers, and they're using all of these hops that are not the way we use hops, and they didn't get it, and so they went from being like 50 breweries in the United States to like 3,000 breweries in the United States in just a couple of years. And they weren't getting any customer service. And there weren't enough hops because all the IPAs that they were brewing used like 4 to 6 times the amount of hops that a traditional pale lager uses. So there's more breweries, there's more demand for hops, and also these brewers are like really into it. They're like, they want to know like how it smells, they want to learn about the process, they want to learn about the farms. Where the AB InBev guys, they're like, take our order from last year, drop it off, and we're going to negotiate your price down to nothing, so you're not even going to make any money, Mr. Farmer. So we showed up in Yakima and we're like, hey, we want to be a broker, we want to be a farmer, but our crop's not going to be ready for a couple of years. We'd love for you guys to teach us about farming, but we also want to buy some hops from you to sell to all of our local breweries because they all want to buy hops. So we filled up a couple pallets, shipped them back to Indiana. We had, fortunately, we had a small cold storage facility we had access to, and we started selling hops. We put in 5 acres of hops on our farm, hired a crew. We started building out a processing facility with a harvester, all of this stuff. And we quickly became the largest hop broker outside of Germany or outside of the Pacific Northwest. Our key advantage was, again, there aren't that many other people doing this. These old traditional hop companies. There was another co-op for growers that called Hop Union that was growing, but there wasn't a lot of competition. And the competition was all based in the Pacific Northwest, where we were in Indiana. Crossroads of America, great logistics, great shipping. And I can tell a brewer, we can ship it to you in 1 to 2 days, and we can get it to you $1 per pound cheaper on the shipping, because we're shipping, these 44-pound boxes or 20-kilo boxes of hops. It's heavy. It's heavy product. It's compressed into little pellets, like you've seen like a wood pellet, like your wood pellet grill. It's what it looks like, but it's made out of hops. Similar process to make it. Fast forward. It was incredible business, a lot of fun. Not high margin, low margin, but we were doing a good amount of volume. It was a volume game. And we were getting ready to make a large investment to build a large cold storage facility and larger processing facility, the first of its kind really outside of the Pacific Northwest. And around the same time, somebody slipped me an apartment deal. It was a broker package for, like 1970s vintage apartments. And this was in 2014. Excuse me. And frankly, I looked at it, and I've been thinking more about real estate. I was doing some analysis, and it really got my brain turning. And I looked at it and I said, let's stop thinking about Sugar Creek Hops was our company. I was like, let's stop thinking about Sugar Creek Hops for a second. This looks like a better business. Like setting my passion aside, because I lived on the farm, got to work outside every day. Then I was either working outside, or I was going over to breweries, drinking beer and selling them hops. It was a great lifestyle, great business. But we were making money, but we weren't making that much money. And I saw this other business that was really making money, good cash flow. And then when I started kind of doing some back of the napkin financial analysis, like we could actually make a lot of money over time. I didn't know really anything, but I thought it looked attractive. So that's when I started an accelerated pace of education. I started reading every book on multifamily. I got into bigger pockets very intensely on the forums, just diving right in. And I got to the point I said, I don't know if making a large investment in this processing facility is the best use of capital. And to my investors, I had a deep look at myself, my wife, Alex, and we had to think about our future, where we wanted to be, in what our goals would be. Right around the time we had gotten married, Alex and I, and Alex was pregnant with our first daughter. So obviously a lot of thinking about the future. And we had to make a decision. And I knew that where the business was, the hops business, we could sell it for a profit. Not necessarily because of the enterprise value. Basically, like our margins weren't a lot, and it was very like just contract based. But we had, and this was risky at the time, but we had entered into large future contracts. Because the way the hop industry works is you're typically buying with futures contracts. So farmers can plan, because it's a major investment to put the plants into the ground. So they want to know that, hey, I don't want you just to buy them from me next year, but for the next 5 to 7 years. And so we negotiated 7-year contracts with some great independent growers, and those contracts scaled up. And so we had some ambitious growth plans to be buying a lot of hops over the next 7 years. We were about 2 or 3 years into it, and we still had a lot of unsold hops. We had not sold all of the hops. Now, you could say it was very risky. We knew, though, that we could sell the hops on the spot market if we needed to and be able to make a profit, especially because our contracted price was significantly below what the same hop varieties were selling for then. So we were in the money on our contracts in a big, big way. So we said, okay, well, we could try to sell these contracts over time, with brewers, our model. Or I could sell the business, sell our contracts, make money, and funnel that into a business that I thought objectively had much stronger prospects. And so that's what we did. Basically sold our contracts. It wasn't like a pure business sale. We kind of sold the assets of the business because, again, we were operating on my family's farm. We sold our contracts to brewers, and we sold our contracts to growers to one of our, I would call it a friendly competitor in the industry, Hollandberry and Sons. Great guys. They got a good deal. It was a win-win. We made a lot of money on selling those assignments. They got a good deal, and they were able to sell those to some other breweries. I took that. It's all right. Let's jump into multifamily. The problem is we really didn't know too much. Kept reading. All I did was read and talk and network. Anyone who was already doing it. Folks who had invested or built thousands of units, to people who done a couple, people who were working in the industry. Got a lot of really good advice. And Alex and I, we were looking at individual deals. What we thought we were going to do is we were going to go buy like a 30 or 40 unit deal. We wanted to finance it with a HUD 223F loan. Because I don't know how I learned about those, but they seemed like the best type of financing. So you get a lower rate, 35-year term, 35-year amortization, non-recourse, which is why we really liked it. It was assumable. Went to meet with a lender locally, Merchants Capital, shout out, Mike Dury. And Mike said, love to lend you guys on this deal. This is exactly what we do. This type of property, I would love to finance this for you. But you guys don't qualify at all. You've don't have the experience of managing a property. You don't have any experience getting a HUD loan. And actually, to get a HUD loan, you have to do a HUD loan. And you have to have HUD loan experience. I'm like, well, how do we get the experience? It's like, well, you could partner with someone who already has the experience. You come into their deal, you sign on as a guarantor, and you start building that experience. It's like, okay, but we really didn't want to partner with anyone, right? Well, we really just want to do this with our capital, and maybe we'll bring, maybe I'll bring my family in, maybe I'll bring some friends in, but it really just Alex and I, we wanted to do it. But then all of a sudden there was a barrier, which ended up being very positive because it forced us to partner. And we got connected with a local multifamily operator they were kind of just getting started. And they needed a capital partner to help accelerate their growth. They needed help on the guarantee. They needed a little bit of capital. And they were trying to buy like the biggest deal they've ever bought, which was like a sub 200 unit property. We were buying it. I mean, it was a 1960s build, value add, rough deal. Speedway, Indiana, which is in Indianapolis. Everything was falling apart. But we loved it. So we did the deal, came on as a guarantee, came on as a co-GP. And that opened our eyes. How these partnerships can work. Introduction to syndication. Had never heard the word syndication. I didn't hear the word syndication until I had probably done 3 syndications. I thought we were doing real estate partnerships. They were doing real estate deals with investors, private equity real estate deals. That's what I thought they were. But we were doing syndications. And that was I started a great partnership with that group. And after 2 deals, I went to my father, who had sold his business, and I said, Dad, you're getting crap returns out of whatever your municipal bonds. Well, he told me he wasn't liking the cash flow he was getting from his bond allocations. He was retired. He had been used to an operating business that was throwing a good amount of cash. Then there was very little cash from these bonds. I was like, I'm doing these apartment deals and they're distributing kind of 8 to 10%, sometimes even more. And the income is sheltered from depreciation. I'm like, there's depreciation recapture at the end of the day, but it's very efficient. And I was like, I've got a deal with this group. We're in the GP. I think we can negotiate. If we join forces, we can negotiate an even better deal. Get more of the GP, get even better terms. So that's what we did. Went to this group and we negotiated terms to get a piece of the GP for their next, 15 deals with major decision rights, so we could choose when to buy, when to sell it, alter the business plan, approve major decisions, things like that. We could fire them if they really messed up. I don't think we really ever had to use any of those rights, but they were there. For a piece of the GP, a minimum investment amount, and we went to town, which was good because Alex and I were basically very quickly running out of our own capital. I mean, the Topps business sale was good, but it was not it was life-changing, but it was not, oh, we never have to work again. We're in such an incredible spot. We had to keep doing something. We did 16 co-GP deals with this group. I think maybe 17. It was a lot. And all in really good times to do it. I remember flashing, this was 2016, looking at the market, looking at the fundamentals, and thinking to myself, supply and demand. We should go buy as many apartments as we can buy right now. The supply-demand dynamics are telling me we could buy apartments anywhere, just about. Do due diligence on them, but we just need to be buying apartments. And obviously that's a very dangerous blanket statement. You can't just buy anything anywhere. But if we had, it would have been a good thing. Obviously, most of you know what happened between kind of 2019 through 2022. Huge run up in prices. At the beginning, we were buying properties at 6% cap rates, for $49,000 a unit. And then in 2022, we were selling the same properties for $120,000 a unit, selling properties for 4% cap rates, 3.5% cap rates. We had a lot of really good exits during that period of time. And it taught us a lot through that process. And I really, really appreciate the group that we work with. We still work with them, good partners. Alex and myself, we weren't building the business we wanted to build. We wanted to have more control, and we wanted to build something with a lasting legacy, in our style, in the way we wanted to do it. And part of it was, I think, a creative endeavor. We want to build and improve things, and simply allocating capital and being involved in asset selection and due diligence and asset management, that was good, but it wasn't scratching the itch that I think I had really set out to do. And I still do this today, not as much as I should, but this period I was doing a lot. Every single night, every single morning, I had a pad of paper next to my bed, and I would write down my goals. And every time, first thing that came into my head, just writing some things down. And often on that list was build a business, build a business, build a business, build a business. And I'd seen what my parents built, the amount of freedom that it had given them, the satisfaction of building an organization that's going to continue. You can step back and it just keeps going, building those systems. And then I had an opportunity to potentially work with another multifamily operator here in Indianapolis. And it was really brought on by, I kind of hit a rough patch with my father. But we'd been investing kind of as a family, kind of family office. It's basically how we were operating. And he was going through some personal things, and we had a little bit of a falling out. And there's a lot of personal things, some business things. And it kind of disrupted that business, that family office business. And I was like, well, I'm going to have to really, maybe think about doing something different. And so I started looking kind of, well, maybe I should just go, we're not going to be able to continue this line. I was like, it's an industry I know a lot about. I can be effective. Why don't I go work for a really good operator? And I basically had an offer to do that. And I looked back at that pad of paper, and I was just going through the sheets, and I was just looking at my goals, and what kept coming up was build a business, build a business, build a business. And I just knew, even though it seemed like it was the easier path, I was like, I'm never going to be able to achieve what we want to achieve, do what we want to do, if I go get a job. I mean, if you've been listening to this, obviously that's never been kind of part of the MO, part of the plan. So I decided not to pursue that, and I said we need to go all in on Gray Capital. Gray Capital was founded in 2015 to build out the family office investing on the co-GP side. That was the first entity that we created. Gray Properties was associated with that. Gray Capital basically ran Gray Properties. I said, I want to start being the lead sponsor. I don't have the whole team, but I know all the pieces. I can put a team together, and we can start doing this. That's exactly what we did. Brought on Jay Reeder. I was pursuing a deal. Jay Reeder, who was working for Gene B. Glitco, watched Jay's episode a couple episodes ago. Really smart guy. We started going after our first deal. Literally, Jay had been on the job for a week, and then the world shut down with COVID. And we really started what Gray Capital is today. again, we'd been doing deals, multifamily deals for the last 5 years, but pure Gray Capital, our own, we're the lead sponsor. It's our deal. We're not just major decisions, but soup to nuts. Get right in 2020. And it was the hardest first deal that we ended up doing 2 deals at once. 2, in our world, small deals, an $8 million deal and a $10 million deal. I know they're big deals, but we're very numb to these big numbers. I'm going to talk about it in a second before I wrap up. Each of them were about $2 million raises. They were the hardest things we ever had to do, but we were able to get it done. And by the way, my dad did not support me going off and doing this on my own. Didn't invest in our deals. He's like, sure, go do, because everyone thinks that like my dad like invested, just supported me through all of our deals. I did the first go GP deals, my own money, on my own, brought my dad in. And then when I was going out on my own, my dad said, absolutely not going to support you. I went and did it anyway. Did a couple deals until he said, hey, I want in. My dad and I we're in a great spot in our relationship, by the way. He'll come on the show at some point if I can get him in here. So then 2020, Jay came to me. He's like, hey, I got another deal for you. I was like, what is it, Jay? He's like, well, it's a big one. I'm like, how big? He said, well, it's going to be about probably a 14, maybe a $17 million equity raise. He's like, it's like a 60-some million deal. I said, Jay, I did the hardest thing I've ever had to do, to raise $2 million for one of these deals we just did. I don't know how to raise $14 to $17 million. And then I thought about it. And I was like, and I was thinking some of the lessons learned on the raises we had just done. The two $2 million raises. And I was looking at the process with each investor. And our larger investors were the easiest to work with, the easiest to say yes, the quickest to say yes, the most excited about the deal. The handful of smaller investors, $25,000, because our minimum was 50, and I think I let people come in at 25. Don't do that anymore. I spent the most time with the $25,000 investors and the $50,000 investors. I'm like, man, that's inefficient. So I asked myself, and I posed a question, a hypothesis. And I said, if it's easier to raise, I go, if I went out to raise $100,000, how would I do that? I'm like, well, I might not go ask someone just to give me $100,000. I'd probably go to 10 people to give me $10,000. Okay. So I'm talking to people who can write a $10,000 check. I'm like, okay, if I want to raise $1 million, you're going to go to people who can, write you a $100,000 check. Like, what if you want to raise $10 million? Well, I'd try to go to individuals who could maybe write me $1 million check. And if it's true that some of the conversations and the process is easier, the more money someone invests because the individual is more sophisticated, it's not the $25,000 investor that may be their last $25,000 to invest. It's much more important to them. They're less sophisticated. They haven't done it as many times. It's like, well, I should be talking to the $1 million investors. In fact, I think raising $10 million it could even be easier than raising $1 million. They're certainly easier than $100,000. It's kind of true. We were able to raise $12 million, which ended up being the amount of equity needed for the deal. A little less than 14. Wasn't as bad as we thought. We raised it within probably 25 days. The seller, this is the middle of COVID, they needed to sell it to someone. They reluctantly chose us. They didn't think we could do it. They didn't think we could perform. The seller, who was a very large developer, very well known, said, I have firsthand information regarding this capital raise and your ability to raise capital, and I've been told you have no ability to raise the money. Well, first of all, I don't know who you're talking to. The only people that know anything about the capital raise is myself and Jay's not telling you that. But it was true that we didn't know how we were going to do it, but we were determined to figure it out. And I said, give me 2 weeks. We'll let you know every week where we're at. And if I can't do it, I'll let you know that we can't do it. But give me 2 weeks to figure this thing out. And we did. It was the easiest raise. It was one of the easiest raises I had to do because I started talking to different people. I started talking to family offices. I started talking to wealth managers. And I found one at the right time. It was the perfect fit. Brought in 2 family offices, a registered investment advisor, a handful of other investors. And I raised the $12 million in a fraction of the time it took us to raise the $2 million for the previous 2 deals. That projected great capital on a stage of being able to do big deals, able to raise money. And we just didn't stop. Now, very turbulent time going forward, 21, 22. Prices were so high. It was so competitive. We couldn't do any deals. We were able to do the deals in 2020 because no one else was in the market. 2021, everyone came back into the market. It was so competitive. There were local groups bidding up the prices 10, 20% over ask, over the whisper. They're just LOIs saying, we'll pay you $5 million more than what you're asking for, and we'll close in 30 days, 40 days. $1 million, hard money, fully non-refundable day one. Here's $1 million, keep it. We couldn't compete with that. So we did very little deals in 2021. We had to kind of find a lane and an opportunity. We did some smaller deals. Then we realized we're not able to enact our business plans as effectively as we want to using third-party management. We never wanted to do third-party management, but we wanted to be able to have our culture on the sites. We wanted to be our people on the sites. If we wanted to change something, we didn't want to have to filter it through a regional manager, the property manager who's not our employee to make that change. So I never wanted to do it, but we have to start managing our own properties. Best decision and most challenging decision we've had to make. It has been so rewarding and so difficult building up property management. The industry is in absolute flux, but it's been so rewarding. We have been able to execute the way we want to. We are building, so we are not done. We are building a culture that represents us, our values, I think in a very different way, in both form and function, in how other property management companies work. Acknowledge that real estate is usually like a generation or 2 behind in technology. And we don't want to fall into those same traps. We also don't want to be suckers for just like the new gadget, because technology is a great tool, but there's a lot of SaaS out there that is bloat and doesn't really solve problems. So we want to be able to provide a great experience. I mean, people are focused on their experience, their livelihoods. We have an opportunity to change and improve the thousands of residents that live in our communities. It's a choice. We can phone it in and say, hey, we're able to distribute to our investors. That's all we care about. Or we could say, yeah, we got to distribute to our investors, but we also need to treat our residents well. We need to be able to provide a living conditions and a living environment that promotes positive mental health and positive outcomes, and people are happy to live. If we can improve the lives of a small handful of people, let alone dozens, hundreds, or thousands, let's put in that little bit of extra effort to try to do that. So that's why I'm really excited about the opportunity, building out new systems, how to do things smarter, centralized but distributed approach. So many great opportunities. We find ourselves in the Midwest, which again, I started investing in the Midwest because it's what I know, it's where I'm from, it's my home. Turns out that Indianapolis and the Midwest, over the next decade, I think it's going to be the best region to invest in for multifamily, I think, in the country. Every little region is different. There's pockets of opportunity everywhere. But no one's been looking at the Midwest. Everyone's been looking at the Sun Belt. And it's got me really excited. We have navigated interest rate increases during deals where we've had to renegotiate millions of dollars, potentially losing millions of dollars of our own money, not investors' money, but own money or family's money as non-refundable earnest money deposit, where we have to negotiate for a price reduction, knowing that the seller doesn't have to and they could just sweep our money. Being told by our attorneys that guys, you're going to probably lose that money. This is not a good day for us. But pushing back and saying, no, there is a solution. There absolutely is a way to solve this and to push forward. And we've always been able to be persistent and find the most positive outcomes. It's not always perfect, doesn't it? It rarely goes as the way we planned, but we're persistent to make a positive outcome. So as we sit here in the fall of 2025, get ready to close a pretty large deal. It's going to be the only deal we close this year. We tried to pursue a deal earlier this year, found some things out in due diligence, led us to not being able to close on it. Lost a lot of money because we had a lot of pursuit costs. I mean, it's done. No new revenue, no new acquisition, no acquisition fees. People talk about acquisition fees as like we put a bunch of money in our pocket, which is true if we do a handful of deals, but we don't do deals. I mean, that money goes to paying everyone's salary, keeping the lights on, our systems. We allocate corporate payroll to the sites all the time and don't get reimbursed ourselves. We do eventually sometimes, but oftentimes we're focused on the outcome for the property. So getting a deal done, closed this year is exciting. It's a big deal, $66 million purchase price, raising $24.5 million. Should be closing in a week. Knock on wood. We're all the money's raised, but we've, a lot of dotting I's, crossing T's, a lot of paperwork, semi-complicated. It's not that complicated, but it's complicated enough. It's exciting. And then the real work starts, executing. We're raising a fund. We're going to try to raise $200 million. Again, these numbers are crazy. From RIAs, family offices. The RIAs are still really on the sidelines. They want to be conservative. They don't want to lose anybody money, and they need more clarity. That's why we're going to give ourselves a year to raise that money, and we're going to be deploying it in 2027. In the meantime, we're still going to be doing direct deals in the Midwest, kind of our core bread and butter, which is like either kind of a light value add to core plus. We've done heavier value adds also. We look for opportunities kind of in our range. We're pretty clear about like things that we just aren't in our wheelhouse. Like we could do, but we're not tooled well enough to do it. That'd be like a super deep value add, like emptying the place out, or grind up development. It's just not what we do. One day it's on the roadmap, but not today. Too many opportunities is what we do. Thank you for coming along with this ride with us. It's fun. We've got a lot more work to do. We're still building. Definitely not perfect yet, but we're dedicated to constantly improving, doing things the right way. And for those of you that have been listening to the Gray Report from the beginning, going back 4 years, thank you. And thanks for Matt for being on the journey the entire time as well, and wish him the best of luck. Make sure you like and subscribe. Like this video, subscribe to the Gray Capital YouTube channel to be notified. I think there's a bell icon. You can click that, you get an instant notification, and check our website out, graycapitalllc.com. Sign up to do deals. We do great multifamily deals. Thanks for watching this episode. Catch you on the next one.